All right, folks, welcome back to the Property Couch podcast, and we've got an amazing show for you today. Special guest, Chief Economist at one of the big banks around this country, giving us insights on forecasting, nowcasting, and also China and US tariffs and what impact that has on property here in Australia. What else do we cover, Ben?
And Bryson, what's making property news? Well, negative gearing and capital gains tax is in the news, so I'm going to have some controversy around capital gains tax. And finally, Bryce, we've got interstate buyers agents who are being rejected by bank valuers. I'll tell you so much more about that risk in the market later in the show.
Buyers agents being rejected? You got to check that out, folks. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, Ben. How are you?
Mate, let's get straight into the show. I don't think we need to talk anything about any sort of sport or round ball games or oval ball game. Just
there'll be a ton of our listeners who are really excited about that because your team...
the South Africans, we beat the South Africans in the T20.
Your team is... Obviously, the wheels are falling off. It's not good. Your theory of most weeks you go to the football and you're feeling good.
I know.
4 out of the last 5.
I've had a tough late July and early August, haven't I?
I know. But look, mate, I'm happy to move on other than to say...
well, you've won 9 out of your last 10, haven't you?
Couldn't have happened to a nicer team to have the wheels fall off this close to September. But yeah, no, Freo's coming along, giving me lots of heart palpitations.
And shout out to Nat Fyfe for her announcing his retirement this week. Absolute legend of the game. So,
Brownlow medalist.
Let's see if they pick up the cup, as he said. Let's go and get that cup.
Well, I saw the beat too as well. Hey, it's that time of year, Ben, where we're doing a summer series shout out to our audience.
Yes, organising our summer series. Yep.
This year we've got two ends of the spectrum that we want to do a shout out to our audience. First spectrum is recently you and I have had some conversations with some people who are on the wonderful end of the property journey, where they've actually ticked the box. They're now getting the passive income goals that they're after. We chatted to one such listener at the Dimmick book launch that we had recently. That was a wonderful conversation there. One of our Bali attendees, Jeff, is also in a wonderful position as well. So we're gathering lots of these little case studies of people who have actually got to the other end. So first of all, if that's you, we want to hear from you. How did you do it? And here's what I found when you're talking to these folks, Ben. They want to stay reasonably humble and like they don't want to grandstand and all that sort of stuff. Yeah. So if that's you, there's ways we can get around that. We can do aliases. We can keep the anonymity there for you if that's something that's important to you. But what's important is the story. It's the aspiration. It's the
transformation.
Yeah, it's just giving people the optimism that they're on the right track. So if that's you,
financial peace, Bryce. For 7 grades, financial peace. Now they're doing financial contribution.
You're climbing the mountain, Ben, and you've got the level 6 financial peace. We want to hear from you. So if that's you, thepropertycouch.com.au/my story. And the other end of the spectrum, Ben, is we want to talk to people who have had experiences that haven't gone as they would have hoped. Ben? We've been talking recently a lot about silver bullet strategies and beware of a different style of information and advice that is coming your way. But what happens with some people is they experience negativity, but they may often go into a shell, Ben, and because there's a lot of emotion that comes around that, lots of negative emotions that come around that. I feel silly, I feel ashamed. So we want to offer an opportunity for people to have a bit of a karmic event or just
cathartic.
A cathartic. That's the word I was looking for.
That's the word.
A cathartic event. So if that's you and you want to help others, if you've been,
no judgment.
Yeah,
no judgment.
actually, there'll be a ton of love that we're going to support you
Yeah,
and
ton of
wrap you
love.
around, because there's part of the processing of that will be part of the journey for you. And
Maybe even some keys to unlock to get through some side doors that might fix some of those challenges.
1000%. We want to just throw our property couch love around you, but we'd love for you to, if you feel like it's part of the journey for you for some of the release of whatever was building up for you, we'd love to hear from you. So there's two.
What are we going to call that? We're going to call it the misfire. Maybe the investment misfire, and then obviously the financial piece. Oh, I'm loving it. Can't wait for. Can we bring Summer Series on a little bit quicker?
Yeah. Well, obviously, there's been lots of themes throughout Summer Series, but I really think that where we're at right now, it'd be nice to give people some aspiration, but I think it's also nice to give people some cautionary tales, but also give those people the opportunity to release some of it. It's a bit like when something goes on, Ben, and you write it down and you get in your journal, and just the fact of journaling, it actually is a lot of the transformation, a lot of the peace that comes over you. I want to offer that to our listeners if you've experienced something that hasn't gone your way, and give you an outlet to talk to people. A, because it'll help others, and B, it'll help you. And C, you and I will obviously give some insights as to what we can do to help with that. So, folks, if that's you, thepropertycouch.com.au/my story. We are starting to talk to folks now as we prepare for that. So we'd love to hear from you. Ben, PIPA survey.
Yeah, just a reminder, the survey will close soon, and it's absolutely critical that we get large numbers of participants. The property market, or the investment property market, is under attack. We've obviously got, potential risk of tax reforms, rental freezes will come back around. This is the data that we go to when we talk to the politicians, when we talk to the regulators, when we talk to industry. This is the data that we get to use because it's from the property investor themselves. It's not through third-party channels such as your property managers or the real estate industry. So it's really, really important that, and if you filled it out years before, it's still valuable for us, right? It's the consistency of the data. It's the 11th year that the Property Investment Professionals Australia have released this sentiment survey. So I really ask you, well, I did mine a couple of weeks ago, straight on the weekend, and it does take about 20 minutes. But again, it's 20 minutes about helping protect your investments from potential changes that might be too extreme and cause financial harm for you. And so if you're interested in avoiding any financial harm, this is your voice. So we need your voice to be heard. And it's through this survey as one of those ways in which we can make your voice heard.
For those watching, the details will be on the screen here. For those listening, click on the show notes. You'll be able to get details for where that is at. Hey, we've got a big guest today. We're excited about that. But my Mindset Minute theme today, Ben, as I've been ruminating on this quote for a couple of weeks now, I think it's really valuable. When you make big life decisions, don't listen to people closest to you. Listen to people closest to your goals. Oh,
no, it's a very powerful one, isn't it?
Let that one land, folks. If someone has a life that you do not want to copy, perhaps you shouldn't take their advice. But if they do have a life that you would like to model or copy, well, then you should take their advice. So when you're making big life decisions, don't listen to people closest to you. Listen to people closest to your goals. Now, people closest to your goals could be people closest to you, so they're not mutually exclusive. But quite often they're not. So we're just making that point clear.
Well, if they haven't traveled that journey, they're normally trying to protect you from getting hurt.
Yes.
And so the point being is, okay, well, maybe I need to have some other opinions on people who have been there and done that. So I like that idea.
All right, Ben, we've got a very special guest today. We are talking to David Robertson. No, not the head of...
We've had a lot of David Robertson on recently.
Planning. In fact, I recently sent an email to our head of planning, and do you know how it auto-populates? Yeah. It actually went to this David Robertson. So he sends me a note to say, wrong David. I've deleted the email.
Sorry about that.
All fine, thank you, David. But no, we're chatting with the one of the more important voices in this country when it comes to economics and markets and research. You'll find out more about that shortly. But let's cut to the interview you and I recently had with another David Robertson. All right, Ben, we've got a very special guest on the podcast today. His name is David Robertson. He's the Chief Economist and the Head of Economic and Markets Research at the Bendigo and Adelaide Bank. Welcome to the Property Couch, David.
Thanks very much, Bryce, and to you and Ben, thanks so much for the invitation to be part of the discussion, and great timing with everything happening around the world and locally.
Yeah, well, it's an interesting week. We're in the shadows of interest rate movements, but look, there's lots to discuss with you today. But my first question for you is there a chart or a data point that you look at every morning or every week that sort of tells you what you need to know to keep your finger on the pulse? How does an economist stay present with what's actually happening with all of the data that's out there?
Look, at the start of every working day, I still use a pen. I jot down in my daily calendar just the key metrics from the overnight session, not just where the various stock market indices have landed, but where the currencies are, and bond yields, the 10-year bond yield in the various key locations, as well as just an update of any of the economic announcements from overnight or the day before, just so that I've got that, and then I can load them into my spreadsheet. And the spreadsheet has got a number of different tabs on it. So there's no one particular data point that I would be most reliant on, but certainly making sure you're up to date with what's happened in the overnight action and is key. And I generally start the day by listening to 2 or 3 podcasts that have a bit of a view of or a summary of what's happened overnight, and I find that sets me up for a productive day ahead.
Well, brilliant. I mean, are you a tragic on holidays? Are you looking at that data as well, or do you let that bank and catch up when you get home?
A little bit of both. So, look, it's hard not to just check that's the trouble with having iPhones, etc. Is it's just one click and you can see what the Dow and the S&P did overnight. But yeah. Try to be a little bit more disciplined when I'm on holidays, but it's hard to get away from, isn't it?
It absolutely is. Now, our community is obviously a community of passionate people who are aspirational Australians, David, and they're learning about investing and money markets and mainly property, but also managing their household affairs. The 10-year US bond market is often referred to as the risk-free rate in terms of, whatever that yield is playing out is effectively the benchmark in terms of what might be called neutral or low risk compared to other investment types. Can you just explain that principle to our community?
Yeah, it's certainly been the default benchmark risk-free rate for some time, and you could certainly mount an argument that, well, actually nothing is risk-free.
Yes,
and particularly when you've been through the pandemic, when we had a heavy amount of quantitative easing, so a lot of extra supply, not just of US dollars, but of currencies around the world.
Yeah.
But again, what's risk-free? What would you default to if you could choose anything? It remains the US dollar. It's the reserve currency. Certainly since not just the US administration going hard on tariffs and on a range of other policies that are really reshaping the world, there's been a school of thought that perhaps central banks will hold less US dollars and might hold a bit more, well, not just other currencies, but gold. I mean, the gold price is at a record high. So many things are at record highs in US dollar terms. Even Bitcoin hit 120,000 overnight. I mean, it's just remarkable. But if you ask the question, what is most risk-free, then it remains US dollars, and the 10-year benchmark is the best way to just to have a single number that represents that risk-free rate.
And so following up on that, in terms of writing that number in this morning, what is that 10-year bond yield currently? I'm trying to think. It's in the 5s, isn't it, from memory?
A little bit lower than that.
Late falls.
Yeah, down closer to 4.3. I must admit, this morning I was on a flight, so I haven't even had the chance to update my spreadsheet. But it's been under a little bit of pressure as tariffs have been playing out, and with the recent volatility in US labour markets and the data, which cost the head of the of the
Yeah,
Bureau of Statistics.
the Bureau of Statistics. Yeah,
exactly their role.
yeah, unbelievable.
Yeah, so look, an easing cycle from the Fed was already underway. It was being paused while we had uncertainty around the impact of tariffs on US inflation. But as we've seen a bit more evidence that the Fed will be easing probably in September, that has put a bit of pressure on both the short and the long end of the curve. The other thing to look at while we're talking about bonds is the spread between the 2-year and the 10-year US bond rate. And when that goes negative, generally that's a forward indicator of recessions. Actually, at the moment, it's still got a bit of a 40-point premium between the 2-year and the 10 years. So that's not screaming recession, but...
in the US, yeah,
exactly.
Yeah, and I think it's just important to finish that point that so if the risk-free rate, supposedly default risk-free rate is 4.5% or whatever it is, you've got to be thinking about that in your household, about where you put your money and what sort of return that you're getting. Because obviously, if you want to take a greater risk, you're expecting to get a greater return than that sort of level. And I think that's the sort of very, very basic yardstick in terms of how people should be thinking about putting their money to work in terms of the types of returns that they might be getting. I don't think that closes that point out. Let's not open that rabbit warren. We'll get back on track.
Well, it's actually what we want to be talking about today. We're going to talk about tariffs and what that affects with the economy and all those sorts of things, David. But we do want to help our listeners understand a little bit more about you as a person and your journey to where you are now. And it sort of started early in those formational years in your household. And we're keen to know, what was there talk of money with your parents and your siblings, if any, that you had when you were growing up? Did you have dinner table conversations with your parents?
Look, we did. I recall, and I was brought up in the Adelaide Hills in Oakbank, which is about 3/4 of an hour from Adelaide CBD, on what was initially a Jersey farm or Jersey stud. Some stage in the 70s, the cows were replaced with racehorses, so things changed a little bit along the way, which I think gives a clue as to my
kings.
Exactly, my father's preferences in that respect. But certainly, I recall the evening meal was always time for 7:00, and it also coincided with the Channel 2 news being there in the background, which was a bit of a discussion prompter for what we would talk about over dinner. And, property was a common topic, not just, both the use of the land and structures upon it. But certainly politics and money were a common discussion point. And Dad had a sort of economics, commerce background, left IBM to move to the land. So money and data were part of his background, and that flowed through to the discussion points. My fascination has generally been with numbers. I've always been a numbers person, so I was always interested in the dollars and the cents and the statistics and the math stats of it. But I was, casting my mind back to those formative years and comments that my parents made around money. A lot of it was around just having a plan and, what are we doing? What are things going to look like in 3, 5 years, 10 years time? And prioritization of your planning and your investment of capital and so on. So there was a lot around discipline and being careful with spending and that sort of stuff.
I was going to say, how did that inform your behaviours once you started earning money? You get, you remember your first job and did you, were you a saver or were you a spender?
Yeah, it certainly did influence me, and not just through my parents, but also through their friendship groups. Got some really good advice really early on that the first thing you need to do is get a property. And my first job, we ended up buying a townhouse, so it was good to get in to that market when it was pretty affordable back in the mid 80s. But good advice is always helpful in that respect. Having said that, haven't always been that disciplined with spending, so you try your best, but life gets in the way sometimes, doesn't it?
There seems to be a common theme whenever we talk to someone who's had an upbringing on the land. Some of these conversations that they are having over the dinner table is probably more pronounced than if there's not that element. I think because there's so much fluctuation and cycles and weather and all those sorts of things that it probably seems to be hard not to have those things front of mind. It sounds like the news was on in the background, but was there a lot of two-way exchange in that, David, or was there a lot of sort of this is what's going on for the parents and you were absorbing it as kids, or was there robust conversations where there was opportunities to exchange back and forth?
Yeah, given I was the youngest of three, I was a little bit perhaps trying to keep up with the conversation in terms of being the youngest of the three children. And Dad was very forthright in his views. It wouldn't always pay you to disagree with him necessarily, but fortunately, Mum was up for the debate, and so yeah, there was healthy banter around it, but you'd have to do pretty well to make Dad change his mind on any particular topic.
Now, can I obviously with the sport of kings comes the odds around horse racing and so forth. You said your love of numbers. Did that start with statistics and probabilities as per the odds of horses?
I have to confess that, both, my parents and their circle of friends did own racehorses and were in the industry. And again, Dad, with his IBM background, he was actually at the forefront of using computers and statistics for ratings on racehorses.
There we go. Yes.
A bit of a thing, fairly new back in the early 70s.
Yeah.
It's fairly commonplace now. But yes, I have to confess that, and not just with sport and things like horse racing and so on, but most aspects of life I try to think about in terms of probability distributions. And, you can't just say this will happen or that will happen. You've got to actually understand, well, that's probably a 70% chance and that's a 30% chance. So let's make sure we've got an understanding of those probability distributions. But yes, that was fairly influential for me.
Great.
David, does that help you as an economist? Because you talk to some economists and then you talk to others, and quite often the economists are using spreadsheets and predicting what's going on. Sometimes it can create inertia in their own personal decisions versus, it's easy to give commentary, from your perspective on behalf of a very large bank. But how is that translated into your own world in terms of, it's a positive and a curse, with the amount of detail that you're able to process at any time.
Well, certainly as an economist, a big part of it is forecasting. I also like to think of part of the role being nowcasting, just being able to explain where exactly are we and how did we get here. And then the next step is, once you've got a good handle on that, you can at least then extrapolate and project. But in terms of forecasting, I'll always come up with what I would call a base case set of forecasts, but then be very keen to explore, all right, well, if that's a 50% probability, what is the 25% upside, and then maybe another, let's get the percentages right, 25% upside maybe split into 12.5 of upward surprise and extraordinary surprise, and then similarly on the downside. So forecasts are, if you like, your median expectation, but it's really important, I think, to explore scenarios, both upside and downside scenarios, and being able to assign probabilities to it. And again, I started in banking on the financial markets side before I got into pure economics. And certainly when it comes to the markets, if you think about how options are priced, if you think about how futures are priced, it's all about probability distributions.
Yeah.
So they're absolutely vital, and I've found that very helpful in terms of economic forecasting.
And it's obviously a social science, David. So it's imprecise. Hence, we talk about probabilities and those types of things. How much of it, because I've got a keen interest in behavioural economics area, how much of that do you factor in terms of when you're thinking about making your most likely predictions and potentially your upsides and downsides? You've got to be thinking about markets, but you've got to be thinking about the behaviour of people behind it, because at the end of the day, economics is a measurement of productivity and activity that's happening inside a marketplace or an economy. So do you think about some of those points around behavioural activities? Because obviously in property, we are a big advocate from day one around human interest and human behaviour, because property in Australia is a status symbol in a lot of respects. So do you think about that more broadly when you're in the macro or when you get into the micro?
Yeah, yes is the quick answer. And behavioural economics, I'm with you, is absolutely fascinating. But if we think about, for example, we've had a cost of living crunch for a couple of years because of the inflation shock. Now we've finally got to a situation where real household disposable income is picking up because we've got inflation under control. Wages growth is about 3.5%. Inflation's down to 2.5%. Finally, we're getting ahead. We're clawing back the cost of living shock. But now what are people doing with that extra income? Well, right now it's primarily going to savings rather than to discretionary spending. And so that's behavioural economics that explains why that's been the outcome. That's the choice of households at present, because they need to build a little bit more trust before that this is a trend that's going to continue, before they'll perhaps loosen the purse strings and go down the path of discretionary spending a bit more. There are so many examples where behavioural economics is vital. And I can also recommend a book I read over summer called Making Sense of Chaos, which deals in a new field of economics called complexity economics, which is a bit of an extension of behavioural economics. It deals with modelling of sort of agent-based modelling, if you like. So it really does go to the crux of the reality that, mainstream traditional economics assumes that we all behave rationally all the time. Life tells us that we don't, that there is bounded rationalism.
Okay. Thank you for my next book.
I've been frantically writing that down. So give us the timeline, David. You've given us a few hints. We talked about the farm. We talked about the interest in punting and the standard deviation. You're now the chief economist at one of the biggest banks in this country. So give us the timeline, right? How did you said, Economics Now was forecasting. What did the first job look like? And when did you actually know that this was going to be your path? What was the spark and what was the catalyst to set you on the trajectory that you're on?
Yeah, so I started in banking in 1989, and that set me on my way. My first job in banking was as a foreign exchange dealer with a merchant bank called Michelle NBD, Michelle being GH Michelle and Sons, the old wool brokers, and NBD standing for the National Bank of Detroit. And the NBD side of that took over that business and became first Chicago, which ultimately became Bank One, which became JP Morgan. So what started off was a small merchant bank, kept growing and evolving.
So that was the monolith that it is today.
Exactly. That was my first job in banking. And again, firstly, as a foreign exchange dealer. And prior to that, I actually had done a bit of school teaching in maths and accounting and so on. So
there's the numbers.
So numbers were at the forefront of it. But FX was a great entree into numbers and banking. So look, I ended up leaving NBD for Chicago to join the State Bank of New South Wales, Colonial State Bank. And after a stint in Sydney there, moved down to Melbourne to run their Treasury business. So Colonial State Bank Treasury in Melbourne. So now we're in the late 90s, and then CommBank came and bought Colonial State Bank.
They did.
And so I had a little bit of time with CommBank, but soon after that joined Bendigo Bank, and I've been with Bendigo Bank for 23 years. So I suppose my background is mainly on the banking side, been financial markets and Treasury. But you can't be an FX dealer or a money market dealer or running a Treasury business without being across not just where's the Aussie dollar going and the official cash rate, but where's the economy heading. And so that fueled my interest in economics and economic research. And with a bit of postgrad work on all of that, the role became available 8 years ago to head up Bendigo Bank's economic and market research area and to take on the role as chief economist. So, yes, numbers have been have been central to all of that. But to your earlier point, it is a behavioural science as well as a numerical science. And one of the fascinating things about economics is you can have an issue which might need a policy response and get 5 different economists and get 5 different answers. So it's only in retrospect that you find out what was the right choice.
Just take the midpoint of those 5 and you probably got closer to
well, exactly.
Law of large numbers. Hey,
agreed.
Treasury roles inside banks. Can you just take a moment to explain? Again, it's not something that the general public sort of get to understand, but if you can summarise the main role of what a treasury does at the back of a bank, lift the curtain on that for us.
Probably the main aspects of it are helping to manage the bank's liquidity, their funding, their capital, balance sheet risk. So wholesale markets are a big part of it. Obviously, most banks, and especially our bank, is primarily retail funded, and has always enjoyed strong access to retail funding. But you've always got to have wholesale funding as a backup there. And so Treasury would typically be involved in issuing short and longer term bonds. Sometimes that'll be locally, but also you need to have access to offshore markets. So getting offshore investors to invest in your bonds is a part of it. And then there's also the customer side with things like financial markets to help customers to manage their risk, be that interest rate risk or currency risk, or just access to money markets. So all of those different parts of debt and capital markets are basically sit under the umbrella of Treasury. And there's the Treasury side that's more so looking at the bank's own funding and liquidity and capital. And then there's the financial markets side, which is there to help customers to manage their risk and to give them access to capital markets.
And so David, on that point, in terms of part of obviously when you're talking about raising that money, that's effectively banks have wholesale funds and then they sell retail, which is obviously lending money, and it's that net interest margin, that difference between is the revenue that the banks earn, and that's part of their profitability, right?
Yeah, that's right. I mean, banks really act as an intermediary. This has really been the case for centuries, that you have a lot of individuals who have great ideas and aspirations but don't have access to capital. You have others who have excess capital and want to get a return on it. Banks act as the intermediary to match the two. And so, the more retail funding a bank has, and I think we're about 80% retail funded off the top of my head, then you've got a pool of funds.
Your cost of funds,
yeah, that's right. But equally, you need to have access to wholesale markets to complement that, and that's where issuing bonds, both say a 3 or a 5 year bond, or even just short-term money market, is there to complement that retail funding. And so that's the excess capital, and then you've got the asset side where that might be home borrowers or it might be businesses. So that's both sides of the equation.
Yeah, beautiful. Thank you.
David, if you had to sum up the Australian economy in 1 or 2 sentences right now, what would you say? How would you do that?
Look, I am an optimist. I am a glass half full sort of a person, but I note that the 20s, we're halfway through the 2020s, has been a pretty traumatic decade thus far. We had the pandemic out of the blue, and then since that, coming out of the pandemic, we've had a global inflation shock. So the first 4 years of it was difficult. But I'm actually fairly optimistic that Australia will outperform, at least for the next couple of years, on a number of bases. Firstly, because the biggest problem we've had as an economy, like other economies around the world over the last few years, has been inflation. And inflation is back at target. We look at the latest CPI data. CPI was 2.1, so at the lower end of the 2 to 3% target band. Core underlying inflation, the trim mean, 2.7% year on year. And actually just in the last quarter, it was just under 0.6. It was 0.59% for lots of that, and you've got 2.36%. So inflation is back under control. So that gives me optimism. And the fact that the Reserve Bank have been able to engineer that outcome through monetary policy, despite taking rates from 0.1 all the way up to 4.35 and now on our way back down now. But the fact that we've been able to have that outcome of monetary policy working, getting rid of inflation, and yet the unemployment rate's still only around 4.25%. So that gives me optimism. So I'm not saying it hasn't been difficult. I know the household cost of living crunch has been there, but I think we're better positioned than most countries to come out the other side. And the other thing I'll say is global conditions are just so uncertain and complex. But here we are with only a 10% tariff that the US has imposed on us. That's the lowest of any of the tariff rates. And less than 5% of Australia's goods exports actually go to the States, which is one of the lowest in the world. So we are least exposed to the tariffs and the trade wars of almost any country in the world, and that gives me optimism. Now, of course, we've got an indirect exposure through our major trading partners, especially China, Japan, etc. But I'd rather be here than anywhere.
I was going to ask you about that exposure to China, because clearly, we take a lot of headlines from the US, but our main trading partner is China, and those two are duking it out. What do you see the ramifications of that, and how that'll? Because we're trying to for this podcast, we're trying to get it to flow on through. Well, how does it flow to the Australian economy, but ultimately to the listener here? What does it mean to them as a property owner? But we've always had this strong relationship with China, and they buy a lot of our raw materials. But if they're copping the largest, some of the largest tariffs against that big US market, what does that flow on have for us?
I think that's the really challenging part, and the RBA have been grappling with that. And the Statement of Monetary Policy, both the latest one and the May Statement of Monetary Policy, have had a lot of information and scenario analysis about not just tariffs directly on Australia, but via China. And I think the general school of thought at the moment is clearly the US and China are going to be doing a lot less trade together because they've got punitive tariffs on each other. So that's going to be inflationary and maybe stagflationary for the US, for China and other countries who are dealing with tariffs. They're trying to find other markets, including Australia. So if anything, it's going to be deflationary for Australia in that there'll be other goods coming to here that might have otherwise made their way to the States that might be a little bit cheaper than would otherwise have been the case. It's not all going to be one-way traffic, but to make a simple observation, I expect the US tariffs to be slightly stagflationary for the US. We'll see to what degree. And but for Australia and for the rest of the world getting on with trade, doing less with the States potentially, inflation might be a little bit less of a problem than would otherwise have been the case. I suppose the other part, though, is a third of Australia's exports go to China. It's our largest trading partner. So we do have this ongoing need to continue to diversify. So we need more free trade agreements and to be doing more with other parts of the world. And there's great opportunities, with the UK and Europe as part of that diversification. So what does it mean for us? Well, at the moment, fortunately, it means the RBA can keep cutting rates. But we need to keep not just diversifying, but ensuring our economy is productive and able to cope with volatility from overseas.
Yeah, David, we got obviously the RBA's call earlier this week. I want us to, for you to grab your crystal ball full of data, movements in there, and tell us where do you see, for your customers in the bank, where do you see the neutral rate sort of landing, and what sort of thesis do you have around why you think that neutral rate will be where it lands?
I think for the next year or two, a neutral cash rate is in the low threes for the RBA. So our forecasts for a little while now have been quarterly cuts of about 0.25%, taking us down to about 3.35 by the end of the year. Next cut on Melbourne Cup Day, most likely timing is November the 4th. And then whether or not you get one more cut after that down to 3.1% or thereabouts in February 26, somewhere in that territory looks like a neutral cash rate. And when you've got inflation down to 2.5, you don't need a restrictive cash rate, so you can have a neutral rate. Now, after that, I think we would, I think it's fairly clearly in consensus that rates then level off and make a bit of a base. The tightening cycle after that is one I don't think we should lose sight on or sight of, but I think that's probably more 2027. And that's when I start to think about, what does an AI economy look like? Surely it's going to be supercharged with growth and output. So that might mean a higher neutral cash rate then. And that's not necessarily going to be a bad thing if you've got rampant growth by virtue of emerging technologies, not just AI, but quantum computing and blockchain, etc., then that can mean a more prosperous economy ahead, but it also might mean a higher neutral cash rate. So to answer your question, in the short term, I think neutral somewhere between 3 and 3.25. But it won't stay at that level it won't be stationary after that. It will keep moving.
I think a lot about what you're talking about there, David, around, AI potentially has the promise of a productivity revolution, right?
Yes.
Now, productivity is the enemy of inflation, which is great. Like, it keeps traditionally high productivity means inflation remains low. But to your point, is your base case then that a tightening cycle could be just an overheated economy, and effectively, that's where you're going to get the reasoning for a tightening cycle, or do you have a different sort of read on that?
And again, we're talking about a cycle that might not start till 2027, so I'm a bit
Correct.
loath to be too specific about it. And so I'm looking forward to this easing cycle, allowing households to catch up and claw back the losses that we've had during the cost of living crunch. But there are a few reasons why I think. Before we get to the next tightening cycle, productivity, absolutely vital. We've got the Productivity Forum in Canberra imminently. It's just so important that they get that right. And that's not just tax reform, it's also reducing bureaucracy, reform in the construction industry, a whole range of areas, competition and technology adoption. But why might the neutral cash rate be higher in the future, and indeed interest rates be higher in the future, 2027, 2028? I think there are probably 4 or 5 reasons. I've already mentioned AI and what technology might do to output. Meanwhile, you've got deglobalization. The world was getting on very nicely for a couple of decades, and then all of a sudden we're not getting on very well at all. And so that can impact on inflation and comes with risks. We've got an ageing population, so that means you get a different ratio of those who are of a working age to those who are a bit older than working age, and more investment in healthcare, aged care, etc. And then you've got transition to net zero, and there are 2 ways to think about that. First is, depending on your view on climate change, I would argue the statistics suggest that we are having more frequent weather-related disruptions, and that potentially adds to inflation. Not everyone's going to agree with that, but that's my observation. But meanwhile, we've got the world trying to transition to having less carbon in our energy sources, and that's not going to be cheap. Now, I would argue we have to do it, but it in itself as a transition is probably going to be a bit messy. Ultimately, renewables will be free if you can just harness the sun or nuclear. But we've got to get there, and that's going to take time and investment and maybe a bit of inflation along the way.
David, with the interest rate easing that we're experiencing now, at headline level, it's better for affordability. But we know that given we've got so much demand for our property market, historically, interest rates going down means property prices go up. So do you have a view on emerging sort of commutable regional locations versus the capital cities? Because clearly the big capital cities, particularly on the East Coast, are where the engines are and where a lot of people want to be.
Yeah.
But given, it's harder and harder for people to get on the ladder early stages, what view do you have on, regional versus capital city in the next 5 to 10 years? And I'm talking commutable regional, not sort of remote regional.
Yes, I've certainly got a very similar view that to the extent that our challenge around housing affordability and some other issues, including transition to net zero, etc., to the extent that they require investment and increase in supply, that regional, in particular commutable regional, offers more prospect of being able to meet that demand than just concentrating on urban locations. So if we look at the regional population, it's now up to about a third. So Australia's about 27 million, about 18 million in the capitals, about 9 million in the regions. And so that 1/3 that is the 9 million out of 27 has just been edging higher, and I think will continue to slightly greater population growth in commutable regional and even some regional locations that are a bit further from the capital cities. So, supply and demand has been out of whack, and that's one of the reasons that we've got housing affordability challenges. And so clearly adding to supply is the aspiration. How quickly we're going to build these 1.2 million houses, I'm not sure we're going to do it in 4 years, but we've got a better chance if we take advantage of regional locations than if we just myopically think of the capital cities. I think regional Australia has such a role to play in that, but not just in housing affordability. All of our challenges ahead, be that, net migration, for example. Why should all the net migration be to the capitals? Then we think of the various productivity challenges we've got. I'm certain that regional Australia can be part of the solution.
Well, obviously Gold Coast is the poster child for regional locations, given, landlocked and lots of people wanting to be there. But what do you think that people should be thinking? I mean, because you can have regional over in WA, or you can have regional down here in Victoria. Or what do you think the framework that people should be thinking about in terms of region? Do you have a view on the commuter belt? Do you have a view on whether they should get out of the Victorian taxation regime? Like, do you have a view where there might be a sweeter spot than others across the country?
Look, I think each state and the territories as well have an opportunity of making sure that government investment, state government investment, and territory investment as well, it is better distributed. And I do think that anything within an hour and a half commute of the capital, as a rule of thumb, within 150 k's or thereabouts, seems seems like a sensible sweet spot. So, from a policy perspective, we've got to make sure that we're able to leverage that opportunity. So I think it's a similar opportunity in each state and territory. But all I'll say is that from an urban perspective, there's less wriggle room. So we can't just be doing big build projects in all the capitals all the time as the solution. I don't think that's an optimal application of capital. And moreover, when we think about the labour force, it's probably taking labour force away from the private sector to less efficient public spending.
Yeah, I was going to sort of build on Bryce's question there, David, around the other mechanism that we have, and you mentioned it earlier around red tape regulation, construction reform, is the planning overlays around productive use of land and increasing the number of semis and sort of townhouses and those types of things, right? Because I think this next generation want to have what they felt like, which is a little bit of a backyard and enough space, but still be in the action and so forth. Do you have any views around sort of that productive use of land and being able to, because all the infrastructure's there, right? So you're trying to sort of build off the additional infrastructure, because we know new estates and all that have a lot of civil works and costs and all of these other taxes, because every new subdivision in New South Wales and Victoria, especially in the city fringes, 50% of that is in taxes, in terms of the cost. So is there any sort of magic wand that you would wave or look at waving around planning regulations to not necessarily just go medium and high density, but to just basically allow for further productive use in terms of, okay, if at the moment the limit is around 450 square metre block to divide into two, maybe if you make that 330 or something like that, and you get these sort of still freestanding properties, you own the land, in the sort of major capitals.
Yeah, so that's the type of deregulation or fast tracking that I think we
Yeah.
need to be advocating for. And I'm loath to make too many suggestions because we've got the productivity forum imminently in Canberra, and I'm sure that'll be not a large part of it, but that will be a significant part of it. And you have the Productivity Commission.
I'm going to come back to that question, David, because I've got exactly that question.
I'll hold that.
Are you on that round table? So we'll come back to that'll be my final question to you about if you were invited to that round table, what's the one thing you'd want to bring up? But anyway, we'll keep going in terms of the general economy.
But in terms of construction, you've heard from CEDA, the Committee for Economic Development. You've heard from BCA, the Business Council of Australia, with some sensible suggestions about how to lift productivity in the construction sector.
Yeah, modular.
Exactly. And so I don't have anything to add to their sensible suggestions. All I'm advocating for is that we actually listen to them and get them implemented.
Well, I guess as we work towards the pointy end of our conversation, Ben's obviously hinted at what his final question might look like. I mean, is there any blind spots that anyone should be thinking about from your perspective, David? Is there anything that's not on the agenda that you think needs to be on the agenda a bit more? That just at the household level that people aren't thinking about, that they should possibly think about, and even if it's everyone's in the easing rate cycle, but you've put back on the table, well, don't forget about 2027. You might need to think about it going up again. But do we have a blind spot that you reckon more people should be thinking about?
That's a really interesting question. Maybe my quick response is, and when I think about AI, we shouldn't just be worried about disruptions to labour markets, and it will be disruptive. But the World Economic Forum put out a paper recently saying there'll be more jobs created by AI than removed by it or disrupted by it. So there's going to be opportunities that come with it. But more broadly, technology generally creates opportunity. And so we need to be embracing the technology and moving quickly with it and being highly adaptive. So I'm not suggesting it's going to be easy, but it will be. History shows us that in general, technological advancements create prosperity. They lift standards of living. The big difference this time with AI is we've never had bots before that can think. We've created machines that can do the heavy lifting, so we don't have to do that. But now they're going to be doing some of the heavy thinking as well. So that is different. And will our education systems be sufficiently adaptable to upskill and to make us mobile? But your question was more through the lens of the property owner and the household. The media at the moment is very focused on trade wars and military wars. There's a lot to worry about, but I do think it's technology that is going to be the main driver of changes to standards of living and what our lifestyle is going to look like over the next 3-5 years. So for mine, that's the part that probably needs a bit more attention. And technological change can be challenging and scary, but history suggests that it generally helps. So we need to be on the right side of that.
Yes, for the first time in human history, we're manufacturing intelligence.
Indeed.
Just let that land in terms of where the world's going to go after that. But we're not going to go down that rabbit warren again today. But just that's the way you need to think about it. These data centers are manufactured intelligence, and these AIs are exactly what that will be. I want to touch on population and migration as one of the last themes to talk about. Usually in society, we need someone to blame for the challenges and the outcomes that we've currently got, and certainly population and immigration and migration, for that matter, has been part of those discussions around housing supply and housing affordability and so forth. More broadly, how important in your mind, David, is population growth, immigration more broadly for longevity and prosperity of this country?
I think it remains vital, and Australia obviously being, Federation was 1901, so we've seen population growth, steadily pick up since then, which has created our vibrant economy that we have today. But it's been challenging over the last 10 years to see that pace of population growth. And pre-pandemic, it was running around 245,000 a year net migration, and natural population growth has been slowing as people have been choosing to have smaller families. But then we had the pandemic and population growth stalled. Then we had the huge surge to try and make up for it. And, we had too many people coming too quickly. And that was part of the inflation shock and the housing affordability challenge. So what's the optimal amount of net migration? We need some, but what's the optimal amount? I suspect it's about 1% of the population. So if we're 27 million, I think about 270,000 net migration is about the right number. So we need to get to that number and be disciplined about it. And the intergenerational report that comes out every 4 years, it did some modelling, and it showed that if you have not just population growth, but increasing population growth at a steady rate, then you'll have better outcomes than just flatlining population growth or even it going backwards. So we do need it. But probably the other thing we need is better matching of skill sets of migrants to where we have shortages. So there's certainly a role that government can play in that.
Couldn't agree more. If we can't bring any tradies in, that's just a shock. That's an own goal. Indeed. Over the last 5 years to bring all these people in, but hold back on tradies because people are worried about their jobs. I don't understand that.
Hey Ben, I think we've had a good go at David's time here. So I've just got one more. I guess it'd be remiss of us to not sort of ask for a quick around the grounds in terms of how you're seeing the property markets performing in each state and territory. We've obviously there's been some headline acts over in the West for a while. There's been movement in the Northern Territory. What can you give us your? We always teach our audience that generalised commentary helps no one, and here I am asking you for generalised commentary. But give us the give us the the headlines as you see it, as you sort of look around the country.
Yeah, and I've been fortunate to get to a number of different regions. Our bank has a strong presence in every state and territory, and so it's good to get around to those different locations and get the feedback from locals. Certainly Queensland and WA seem to be the strongest economies at present, and you're seeing that matched with the appreciation in residential property prices. Victoria clearly is it's been in the slow lane, both for economic growth based on gross state product and also with residential property prices in Melbourne and more broadly. And there's the obvious debate around tax, land tax, etc. But that's the sort of three-speed economy I'm seeing at the moment. It's WA, Queensland leading the way, Vic a bit slower, but not going backwards, and the other states and territories somewhere in between. From a residential property perspective, a deceleration in that appreciation of property prices, but coming off a remarkable pace. Pretty remarkable that prices went up. What was it, about 20% in 2022? Sorry, in 21. Then had a bit of a breather in 22, and then 8.5% capital city growth, and then 5.5% in 2024. So I'm looking for capital city price appreciation to be a bit slower, but still somewhere of the order of 3.5% to 4.5%. I think other forecasters have got it a bit higher than that. But supply and demand are going to be changing over time. We're going to have a bit more supply coming onto the market, and as population growth slows, a bit less demand. But again, to answer your question, I still see Queensland and WA as being in the fast lane. Interestingly, for Melbourne, where I live, we've been one of the underperformers for a number of well-documented reasons, but we've gone from the second most expensive, if you like, or unaffordable location to probably the second most affordable. So that will all even out over time, and I think investors are thinking about that wow, Melbourne's getting cheap. So
what's your message to Victorians then, given that our economy is stifled, we've got a lot of tax, we can't afford the interest bill, they're trying to get property investors to pay for that. What's the message that you would say to Victorian property owners?
Look, I think we've been through the correction now, and I think we have, by virtue of relativities, now become a bit more affordable, or a bit relatively cheaper. And so I'm not a pessimist. I think we've been underperforming, but we've probably now got to a level where things will chug along and gradually pick up. And again, sort of a few different opinions that actually Melbourne, having come more affordable and having underperformed, is now a better place to invest than some of the other locations. And I do note that Victoria is enjoying a high level of population growth by virtue of net migration that wasn't there a couple of years ago. So, look, I think we need to be very careful when it comes to tax policies that aim to claw back debt. You need to grow your way out of debt, not just tax your way out. But I do think that Australia will be growing at a nice clip in a couple of years' time, and I'm sure Victoria will be a part of that.
Oh, well summarised. So, let's go back to my final question. You've got your little invitation on the Treasury letterhead from Dr. Jim Chalmers, and you're off to the economic roundtable. What do you put on the agenda? What's one of the big things that you would want to see done to move our economy forward, which obviously then brings prosperity and improved living standards for our citizens?
Well, unfortunately, my main suggestion from a tax perspective is one that I think the PM's already ruled out. I think taking the GST from 10 to 15%, but having an offset for lower income families, and there's an easy way to do that. You can engineer that just by once a year payment, so that actually up to a certain amount, GST is slightly lower than 10%, but then in aggregate, you end up well ahead on the deal. So if you could take GST from 10 to 15 with those offsets and then get rid of stamp duty and a few other taxes that don't add to productivity, that would be better for the country. Unfortunately,
broad-based as well, David, or keep it as is?
I do quite like the arguments for broadening the GST base, and that might include fresh foods. I know there's arguments against that, but at least exploring those alternatives. So I think it would be a mistake just to say, no, we're not going there. We're not even going to look at that. I think it needs to be looked at. And maybe we need to take it to the next election and just say, well, we had a forum. Here's why they recommended it. Voting public, what do you think? But that's obviously politics comes into it, which is challenging. It
kind of makes sense too, doesn't it? Because you see that there's an exodus of high net wealth out of the UK going towards more better taxation environments. So it kind of makes sense that you do what you've suggested and try and bring income tax rates down, so it makes us competitive for people to want to stay here over time, because we enjoy the benefits of this country, but over time people will still go where they're treated best in terms of their income tax as well.
I think there's a tipping point, and you can even see it in tobacco. You get the price of tobacco too high in cigarettes, and ultimately you create a black market. So and then now you've got to put all of these inspectors and operators in, and you've downgraded what you're going to believe are the billions of dollars of tax revenue you're going to get, and you created a black market for organised crime syndicates. So same, and to your point, Bryce, if you tax the wealthy too much, they just pick up their wealth and
go somewhere else.
Go and take it somewhere else. So I think consumption taxes are, if you want to be over consuming, you pay more. And I think that's why they're such a fairer tax if you have the vulnerability, the most vulnerable in our community protected against that. And I know the argument on fresh fruit and all of that type of thing is that, they'll eat processed foods and they'll go eat junk foods. So I think we've got to just be smarter about that, and us having conversations around this, and then hopefully our community also having conversations around that's a better tax than charging us, our income taxes or even corporate tax where we don't get that capital injection. Makes a lot of sense. So I appreciate you raising that one, David, as part of what should be in the debate, because it's clear to me that that hasn't been moved for over 20 years or thereabouts. So it's time. It's time to take a look at it, because governments want to keep spending. The problem with it is that once they run out of other people's money, they get into debt problems, and those debt problems then spiral into massive problems. We're talking about decade-long issues, and they try and tax their way out of it. That's not that. To your point, David, we need to grow the pie, the economic pie, and then be able to tax less, but tax broadly as part of that story makes a lot of sense.
Yeah, and probably the two other things. So that's GST. There's other tax policies that need review. The PRRT, I don't think it's working terribly well. So that could be revamped. The Petroleum Rental Resources Tax.
Yeah.
And then there's ways of lifting productivity that haven't got anything to do with tax at all, which is all about reducing bureaucracy. We're so much more bureaucratic than most countries around the world, harder to do business here than other countries, so we can do a lot better at that. And I'm sure there'll be some wonderful suggestions from the likes of the Productivity Commission and others about how to do that better. So my point isn't so much me having new ideas, it's trying to be more, trying to increase the probability that these sound suggestions actually get implemented.
Great.
Very good. Well, David, we could chat to you for hours. We know you've got other commitments today. We know you jumped off a plane to come and chat with us, so that was another logistic that was a challenge for you. But look, we've enjoyed the conversation.
Yeah.
Our community will be better for your insights. And on behalf of everyone here on the Property Couch, thanks for joining us today.
A pleasure. Cheers.
Thank you, David. Wonderful.
There you go, Ben. We could chat for hours, let's be honest, talking about that. But some unique insights. We've had a lot of economists on the show over the journey. We know the connection to China. We know that, going around the grounds, we talked at the end about, some headlines. But what we did is we unlocked some of the insights and what's going through David's mind. And I think that hopefully our audience enjoyed that. But I think there was some really cool insights that were fresh and should be helpful for people as they're making decisions around where is Australia at right now? How does that impact me as a property investor?
Well, I like when you talk to someone who is, at the peak of their powers, they're subject matter experts in their area, they're very measured. They're very considerate. You could see him just processing and thinking and articulating and narrating his words really clearly. So I thoroughly enjoyed that conversation because we went in a lot of different areas, but it was all still within his sphere of influence and understanding. And so, I just really, I'm going to be listening to a lot of David's commentary going forward because there's a lot of wise and measured input. And like you and I, Bryce, he is an eternal optimist, right? We are glass half full, not glass half empty. We get a little bit frustrated and annoyed with people who are doomsdayers or feel that the problem's not theirs to solve. Thank you, David, for coming on the show. It was a lovely chat.
And you got a book recommendation too, Ben, Making Sense of Chaos. So
I've got it down here.
Frantically scribing, but also just the depth of experience, from merchant banking and FX, and then the State Bank of New South Wales,
Treasuries,
little toe in the water with CBA, and then obviously with Bendigo Bank now for the last 23 years. So thank you, David. We appreciate your insights. Thank you for joining us on the Property Couch. Hey, my Life by Design hack today, Ben, is all about what I think has been my most silent weapon in my life. And so it's this. I saw this quote: marry someone who claps for you in public and coaches you in private. So I'm married to someone who doesn't want the limelight, is not interested in the limelight, but is very, very wise and acts as a very amazing counsel to me. So I'm really happy about this. And one of the things from Scott, who was with us in Bali early in the year, one of the bits of feedback that I really enjoyed is he said, look, it was great to meet the rock behind the voice, is what he said when he met my wife, Andrea. So marry someone who claps for you in public and coaches you in private. And for anyone who's in a relationship that has that dynamic where, when you're on stage, you are supporting each other, but you have those conversations before. I know that you've got that too with your.
Oh yes, I agree. Ditto on that with my beautiful Jane.
Yeah, and clearly you've got exceptional talents in choosing wives too, given that she knows how to pick a football team, unlike you.
Yes, Freo supporter. Yeah.
So, that's my Life by Design hack today. As we roll into what's making property news, Ben.
Well, Bryce, I mentioned this at the very start of the show about, the big decision that Labor made, which, as I said post-election, when Albanese talked about aspiration and making sure that it's a cornerstone for Australians, I really like that story. I mean, Albo's had several investment properties. He's bought his forever home. He has worked in public service and he's now the Prime Minister of the country. But he hasn't lost sight of the fact that, you've got to pursue a purpose. And then to effectively say no changes, negative gearing, and capital gains tax for now is actually a good move on negative gearing. But I'm going to be controversial here to some investors who don't want any changes to tax. I'm telling people now we're seeing the emergence of speculation in residential property like you and I have never seen before. Like there are literally hundreds of new buyers agents who are coming into the market, and there is a lot of speculation buying that is going on in the market. And so we need to do something about stopping this speculation buying, because guess where it's also happening? It's also happening at the cheap end of the market. And so that is also robbing first home buyers of getting on the property ladder. You and I have taught people on this podcast through our books that getting on the property ladder is the first move. It's not the forever home, it's getting on the ladder. But if we're making it harder for people to get on the ladder because we've got situations where, and I'll give you an example, an area of Melbourne, recently one of our buyers agents, 12 offers, 1 from an owner-occupier, 11 from buyers agents, right? And of those 11, there were 9 interstate buyers agents who were trying to buy that property sight unseen. All right. Now, this leads into another bit of feedback, Bryce, that we've had around bank valuers, and they're seeing it happen. They're seeing these markets basically being artificially inflated or accelerated beyond what would be a reasonable rate of growth. And that's why we're saying it's speculation, it's trading, it's not long-term investing. But these bank valuers are ringing the selling agent, Bryce, and they're asking these questions. They're saying, the valuers are asking, did a buyer's agents buy this property? Number 1. Did the buyer's agent inspect the property? Number 2. Now, and what they're also doing is, they went on to say that these valuers are also not taking into consideration any off-market purchases that might support the valuation. So there is risk for any of these people who are buying in these areas that the valuation might come in short, which could affect your loan to value ratio, which could affect your ability to get your loan approved. So even though you've got pre-approval and you're thinking this is great or these are cash offers, this is the problem that we've got. So we're now starting to see risk creep in, and I'm calling this interstate buyers advocacy market risk, because that's what we're talking about here. That is potentially going to be a problem. And that's why, coming back to the capital gains story, we need to move out the concessions that are being offered. And this is a policy of PIPA, and it has been a policy for several years now, that in the first year, no concession. In the second year, we talk about a 10% capital gains concession, third year, 20, et cetera, et cetera. So after the 5th year, you get back up to the 50%. So rather than the 12 months where you get to 50%, that is encouraging some speculation. And Bryce, you and I have been that we do not want residential property to be a speculative asset, but it does feel like that this pumping and dumping that's happening in the market, it's almost like crypto, or, Doge coins and all these crypto coins, Mark II, because there's no regulation in here. And so there's got to be something that needs to be done about it, because it is getting a little bit out of hand, because everyone's just picking cheap markets and say, throw a dart at it, buy whatever. And because every other buyer's agent's in that market, they're pumping those particular markets up. And that is unsustainable. And it's not, we don't want property to be that level of a commodity as a trading asset. We want it to be a long-term private rental accommodation, income producing asset over time. So there is my little what's making property news, which is sort of semi-passionate plea and a rant all mixed in one, Bryce.
No, well, we're trying to help people. I mean, I remember back in the early noughties where, maybe even the 10s, that early noughties, and the valuers would then, I think they're not Muppets. They're incredible.
Well, this is what happened in house and land packages and all that. Yeah, with rebates.
Or what they do is they go, property purchase address, property purchaser address, right? In New South Wales, Adelaide,
yep.
So that was a flag, and so they use that as flag. So now they're actually, obviously becoming more and more sophisticated in how they value these properties, and now they're just asking, was it a buyer's agent? Was it a buyer's agent who actually inspected it? So so we're just lifting the bar. We're the insider's guide here on the Property Couch, Ben. So we've got to give people what the insiders are looking at. But these are some of the internal emails that we're seeing that are happening on the ground now, folks. So anyway, that helps you out. Well done.
And look, it's a good little segue into our market update that we're also going to be doing. So we'll do a deeper dive into our market update on the 21st of August. So that's next Thursday.
Next Thursday. There we go, folks. But big show. Thanks again to David for jumping on. Thanks, as always, for your contribution, Ben. And until we do the property market update next week.
Knowledge is empowering, but only if you act on it.
Only if you act on it. See you next week, folks.